I'm not sure I know why the chicken crossed the road, but I do know that the short seller beat the chicken across the road just so he could bet against the chicken's success. Okay, I got one a little bit better than that. All right, I promise. Here we go. What's the short seller's favorite dance? It's the market dip, baby, dip. Dip, baby, dip. Come on. Okay. It's kind of hard to approach short sellers and the topic of short selling with a lightheartedness, given the amount of drama and stress they create for all of us. And it's like, when you're in a casino and you're playing craps and someone comes and bets the don't come line. Instantly, someone does that. Everyone wants to line them up and start smacking them around like they were in the movie Airplane. I understand that betting with the casino is the smartest move, but betting with the bank just feels slimy. Speaking of slimy, we need to talk about the latest nonsense the banks have pulled. And it's absolute insanity. And I've gone on record that I don't really believe in market manipulation. And one of the reasons is that the rules are so shady that they can legally manipulate the market and not have to do the things that JP Morgan and other banks have been caught for. They only do those things because they're just being greedy. Because as the saying goes, pigs get fat, hogs get slaughtered. The system is so crooked and it's so much in their favor that they don't need to cheat, but yet and still some knuckleheads do it. That aside, again, we don't normally talk about depositories or inventories or COMEX or short positions because I just find that market to be really shady and opaque and find a lot of the information to be almost pointless and adding very little value. However, the last few months, things have shifted and we need to discuss it because the implications to the bottom line, at least in the short term, are pretty powerful, I think. For those of you that are new to the stacking community, there's a real controversy in our community around ETFs and paper silver and paper gold, and many folks don't like it, and I understand that. But one of the biggest reasons is because the paper drives the physical market, which is absolutely insane. That the number of shares that are traded on the open market compared to ounces are just completely disproportionate and should not be in any way driving what the prices are. But that's the crazy market that we have. So what does this change that I want to talk about? It's with the iShares Silver Trust, known as the SLV. Recently, they had an unprecedented 146% increase in short positions in just 2 weeks. The short position in SLV absolutely skyrocketed from around 20 million shares to 50 million shares right around Christmas Day. Again, 146% increase. And from what I can tell, and this data is kind of hard to get your hands on, it seems that the increase was specifically related to banks being unable to deliver 30 million ounces to the ETF as required. So instead of securing the metal and driving prices higher, it was literally easier and cheaper for them just to short the stock. Now, this makes me mad as hell. And it's not that they're cheating. I 100% expect them to cheat. It's just infuriating that they didn't even put the minimal effort in to try to appear that they weren't cheating or pretend. I mean, come on, man. I kind of glossed over this, but let me try to explain it in some very simple terms. Because SLV is an exchange-traded fund designed to track the price of silver, it's supposed to match its shares with the physical silver held by the fund. So why would SLV not just go out and get the silver that they're required to get? I'm going to put my tinfoil hat on here, but this makes me think either physical silver is becoming too hard to source or they're terrified that it will drive up the spot price. The shorting of the SLV silver basically keeps silver prices low and disconnects them from the reality of the real supply and demand market, which is really kind of like the bane of all of our existence, right? We all know that there's always been these Western banks, primarily bullion banks, and their trading desks controlling silver price through futures trading. And they have the power to engineer these price drops through paper trading. And the frustrating part is that it has been a driver of the market for a very long time. The funding games that they play have effectively severed the connection between silver price and the real world supply and demand dynamics of it. It's actually so bad that 20% of the annual global silver production is currently being shorted. This is what leads me to believe that silver will continue to be under pressure. How can I be so certain? I have one major reason and two very strong reasons. Let's start with the two strong reasons. One, let's just do the math. With the current short position, every dollar increase in the silver price costs the banks around $200 million. Talk about having some skin in the game and some motivation to drive the price down. My second reason is that we saw this 2 or 3 years ago. Remember when Bank of America was caught short and it was somewhere around $24 and $25 and silver conveniently went back down to $22, allowing them to clear out their short position? Well, sitting and crying about the unfair rules and the banks taking advantage of it just doesn't do us any good. So we have to focus on what we can control. And let's focus on getting even instead of getting mad. Well, getting even is really a long-term play, but we can still do that. They can only play this paper versus physical game for so long because every day the supply and demand dynamics become more constrained. Be it the static production levels from mines, increased industrial usage, flat levels of recycling, or shrinking above ground inventories. It's all a shell game that will have to come to an end at some point. They simply can't keep papering over what is real and what is a growing silver shortage. Now remember, these things often take longer than we would like and even longer than we would expect. Now, in terms of my one major reason, and you've heard me warn about this multiple times, and I don't think you guys really are paying attention to it as much as I think you should, silver as an industrial and a monetary metal, and because of that industrial nature, silver does not respond well during recessions. I don't know when the recession will finally arrive. At this point, it feels like we've been talking about a recession coming for 3 or 4 years. The point I want to make is that we are finally starting to see some cracks in the economy, and the inevitable recession just might become imminent. Though this matters for silver because during the past 55 years, there have been several recessions, and each one, silver has not performed well. Take a look at this chart of all the recessions, and I'll give you some of the statistics. Recession number 1 back in November of 1969. Silver was just under $2 an ounce. A year later in 1970, November of 1970, silver was trading just below $1.60 per ounce, a decline of 20% during that recession. Recession number 2, that one was February 1974, right as silver was peaking at $6.80 per ounce. 14 months later, April 1975, the end of the recession, silver was trading at $4.35 per ounce, a decline of 36%. Just like with the previous recession, silver continued to decline even after the recession ended, all the way until March of 1976. 2 years later, silver was trading under $4 an ounce, which was a total decline of around 45%. In recession number 3, silver dropped during that time frame from its peak of $50 per ounce to a low of $15 per ounce in July of 1980. And that there was peaks and averages, so we're going to call that 36 an ounce and the average monthly price of 18. And if you count it that way, that's still a 50% drop during that recession. Recession number 4, 14 months later, June 1981, there was another recession and silver was down 45%. Recession number 5, there was a decline of 25%. Recession number 6, there was 10 years later, and that was in 2001, and silver was trading just under $5 an ounce as the recession began. And then a year later, it was trading as low as $4 an ounce, a decline of 20%. And then recession 7, the last recession in January of 2008, and that we saw a 40% decline from silver. After the recession ended, silver renewed its climb up to about $50, where they gave it all back and went back down to $14 per ounce in December of 2015, and again in 2018. Here's what we know about silver's performance during recessions. Every recession, a total of 7, in the past 50 years has seen silver decline in price varying from 20 to 70%. This is true regardless of whatever trend it was in prior to the recession. Bullish or bearish momentum, trend direction, none of that seems to matter. And in 5 of the 7 recessions, silver's price continued to decline after the recession had ended. If you're buying silver because you expect a recession will take your price higher, I think you're skating on thin ice. The expectation has to be that during recession, silver is going to fall, and that's why you got to have some dry powder so that you can pick it up at a discount. Right now, we have 2 competing forces trying to control the price of silver: interest rate cuts and a potential recession. Historically, with the Fed lowering rates, we've seen metals perform incredibly well. For instance, during the 2000 rate cycle cut, gold prices increased 30%. And in 2007, we saw gold rise by 23%. And in 2019, we saw it go up by 16%. Silver, being silver, performed like a wild dog. In the 2019 cycle, silver went up 32%, but ended the cycle by down 3%. In a nutshell, we know the banks are massively short and they never lose, so we can expect the price to get beat down. While we are in a rate cutting cycle, the Fed has also tried to move the goalposts and pretend like they're not going to cut as much as they said they were going to. 3, we know a recession is looming somewhere. And 4, we just need to be watching for signs of quantitative easing, because that will serve as jet fuel for the metals. In the meantime, all we can do is stay the course knowing that the shenanigans are going to happen. The volatility has to be seen as your friend, and if you believe in silver's fundamentals, just buy and hold tight and ignore the noise. For those looking for exposure to silver prices without owning the physical metal, yes, you could definitely get into the paper metals with SLV, or you can even get into mining stocks. No matter how much I hate paper silver, I do have to agree that it's better than having no silver at all. Remember, when it comes to mining stocks, they are a great way to get leverage, but they come with their own set of risks, and you have to do your own research in that regard. And whether you're a seasoned investor or just starting out, the 2025 market is going to be a fascinating one to watch. In the comment section, what keeps you motivated to keep buying silver? What's your favorite piece of silver? Or simply put an A+ in the comments so everyone knows that you always stack smarter and never stop learning.